Hello. I am Chris Brummer. I am a law professor over at Georgetown, but I started my career at Vanderbilt as a baby professor over in the law school. So, I'm still, very proudly go Doors kind of guy, and also CEO of the Fintech Foundation and DC Fintech Week, where everybody is also invited to participate.
And Blueprint.
And Blueprint, yes. I also have a startup that deals with many of the issues that we'll be talking about today in terms of sort of automating compliance on chain. I don't know how much longer you really want us to speak. All right, we have a lot of people, so I don't want to monopolize the time here.
Hi, I'm Linda Jeng. I'm the Chief Legal and Policy Officer at Aave Labs. Just started there. But I'm also a visiting scholar in financial technology at Georgetown Law. Used to teach with Chris.
Hi, I'm Sara Weed. I'm a partner at Gibson, Dunn. I co-chair Fintech and Digital Assets Practice. That might be the least interesting thing about me, but that's where we are. I'm a recovering state banking regulator, and I'm a crypto dinosaur, so I'm excited to be with you all.
Hi, everyone. I'm V. Lee. I'm the General Counsel of Veda. We build vault infrastructure.
Is this on? Can you hear?
It's on.
It's on? Okay. It's kind of gentle. Yes, I'm Salman Banaei. I'm General Counsel of Plume, a real-world tokenization project. I am also, like many of the others, I've been a regulator at the SEC and CFTC. And look forward to this panel.
Hi, Amy Oldenburg, Head of Digital Asset Strategy at Morgan Stanley. And I split my time between New York and Florida, so I'm very eagerly waiting the new Vanderbilt campus in West Palm Beach. 2029, I volunteer my services when it opens. I can walk to work.
Great, and I'm Mark Berberian. I'm with Analysis Group, and very excited to moderate this panel, and we can hopefully have a lively discussion here.
We have a bunch of wallflowers in this panel. You're totally not going to get that with these two.
So, Linda, do you want to kick us off that many view equity market structure as already highly efficient? So at a high level, what's the real value add from tokenization, and does it require rethinking underlying legal frameworks like ownership and enforceability?
Super easy question. So I remember when I worked at the SEC, 20 years ago or something like that. It was actually on Reg MNS, and that's when I learned how that even came about. It was because of the paper crisis. Does anyone remember the paper crisis of the New York Stock Exchange? 1968? The New York Stock Exchange couldn't handle all the shares that were being traded. It was like 12 million shares a day. It was all in paper. And they just couldn't handle it. They had to close down once a week, every Wednesday, close down. Sometimes they had to close earlier in the day because they just couldn't handle the volume of paper. And so that's when they started moving towards a central registry, which we now know as the DTCC. And the DTCC just stood in as the main registry for the public. And that's where we know where beneficial ownership is recorded. And it's worked for, half a century. And then here comes blockchain technology. And so this now raises the question around, do we still need a central security depository? And then also, do we need a transfer agent as well? And transfer agents are those that actually help to record the transfers and securities and also help manage corporate voting transactions. So these are questions now that are really being kind of raised for the first time because of this type of new technology that allows for a shared distributed ledger and automated agents.
Thanks. That's super interesting and gives a good historical context of where we are. V, I know you are really passionate about tokenization benefits. Can you share with us your insights there?
Yeah, sure. So, I think traditional markets are very efficient at certain things, right? Like price discovery, they benefit from very deep liquidity and decades of institutional learning. Where they're not efficient is at things like custody and settlement and transfer transfer of ownership, right? So like if I sell my stock, it's at least 5 days before that money hits my bank account. That is not efficient. But I don't think that efficiency is the only and even main benefit of transitioning to on-chain capital markets. I actually think one of blockchain's most interesting and maybe important contributions is it replaces intermediaries with infrastructure, meaning systems that are rule-bound and controlled by rules, right? Which means that you can bake things like fairness and accountability and integrity directly into the markets themselves. And I actually think that that is game changing, right? It allows you to achieve investor protection and market integrity in more efficient ways. And it completely changes the nature of how compliance is conducted. And it modernizes the way that regulatory oversight works. And so I think those are really underappreciated aspects of transitioning to on-chain capital markets that I would just love to see us focus more on as a policy community.
Please jump in.
I'm totally wrecking the flow here.
No,
I
this is what we
recognize that.
want.
But Chris said we were going to do this. I'm just kidding. This isn't your fault. So you said something really interesting about sort of baking into into the technology, sort of the things that we would otherwise sort of impress upon intermediaries in these transactions. Is there any tension with the sort of idea that we don't regulate technology if we're sort of assuming that we subsume, and this might be a question for you, Chris, like when the technology starts to sort of act in ways that are, consistent with how we have thought about those that we would otherwise regulate, does that change our relationship to the technology and that sort of like bright line that so many have drawn that like we don't regulate technology, we regulate intermediaries? Jump ball.
I'll let you start, and then I'll clean up.
Yeah, so I actually think that this, like the right way to think about, as we're transitioning to on-chain capital markets, how do we think about adapting like regulations to this very new system and this very new technology? I think the right way to look at it is not how do we adapt existing regulations, right? Because that's not what regulators regulate. They regulate outcomes, investor protection, market integrity, accountability, fairness, these sorts of things, right? And so the right question and the right framing is, can this technology achieve those regulatory objectives in an equal way or sometimes even in a superior way, right? So that's what it means for me, at least, to be tech neutral, and I think that's the approach that regulators should take.
Okay. Well, Salman's raising his hand.
Yeah, so I want to take issue with something I've heard on a number of panels, which is only intermediaries are regulated. That's not correct. So, for example, introducing brokers are not intermediaries. They will take a customer order and then route it to a clearing broker, which then routes it to an exchange, which then routes it to the DTC for clearing. That's just one example. There's also types of clearing agencies that act as middleware for settlement purposes, and they're also not intermediaries. So when it comes to certain core parts, important parts of the current TradFi financial system supply chain, we do have regulation even when the service provider is not acting necessarily as an intermediary. And when we think about how to bring this technology and bring it into the core of the capital markets, while ensuring accountability, I think we still have several touch points where that accountability could be established across the entire supply chain, regardless of what technology is being used.
I see Amy nodding. Yeah, if you want to jump in.
Yeah, I was just going to add to that. No, I think you're so right, and I talk about this same thing where I think a lot of what we've been doing is we've been unpacking the pipes and plumbing. Is you realize a lot of people don't even know how our complex infrastructure is put together. So exactly to your point, we bring up things like intermediaries. It's not actually correct, but that can go to a lot of the questions that come up around tokenization generally. Is a lot of what we're doing is reteaching ourselves what the legacy infrastructure even looks like today, so then we can go and replumb it for the future.
So just to get to a couple of things, I loved how you started off because I've been, the last couple of months with my academic hat, talking to regulators and then from the company, now we spend about 75% of our time talking to regulators about the fact that what we even define as compliance is totally going to change. Like, there's such an emphasis on market structure in terms of the trading life cycle and how that's going to change with the introduction of blockchain-based technologies. And I go, I talk to everything from enforcement agencies to central banks, and I say, hey guys, you think that's going to change? Just give it 3 years in terms of what your job is going to look like. It's going to change dramatically. And it is a lot of the question as to how exactly is the infrastructure itself going to operate. To the question as to the tension between, it's almost like a kind of a merits-based question that you have baked in there. And I think that regulators are always going to be, I think there was an earlier conversation, maybe it was Justin who said like deciders about financial regulation and what those rules are. But I think that how the rules are ultimately intermediated along with the financial products themselves is that it's all kind of getting baked in together. And it's not so much that the regulators are starting to sort of change or to engage in the merit-based regulation. It's just sort of saying the way in which we share our rules is going to change. So paperwork crisis, instead of sort of writing you a really, really nasty little letter that I put into an envelope and mail off and you'll hear from me in 2 or 3 weeks, the immediacy of being able to communicate with the market and the means by which the market's going to hear what you're doing is going to be a lot faster, and it's going to look a little bit differently from the way it has been before. So I don't really think of it as like a new kind of merit regulation over the infrastructure. It's just an understanding that the infrastructure itself has expanded utility through which you can exercise your regulatory supervision. And like many of us, probably everybody on the stage, we've been traveling, talking to regulators all over the world, and they're coming up to speed pretty quickly in understanding this, although the popular narrative is very different from the kind of market conversation that you may hear on X. I just said that because they said X last time, so I'll just continue.
I'd love to build upon that. So Aave Labs, we support the largest decentralized lending protocol in the ecosystem. We have around $27 billion in TVL. And this infrastructure really is an infrastructure layer to which, retail users as well as institutional users can plug in and integrate with the base layer. Now, that means compliance can become an embedded layer, as literally a middleware where we actually screen for sanctioned wallets when they access the protocol. And so this is like real-time compliance, not ex post, like, oops, someone got in and now as a bank you laundered millions of dollars for someone. It's like, no, we actually can identify and prevent these bad actors from using the infrastructure.
And just to build on that, right now, from what the central banks, on the private side, you can certainly build the transactions and you can create the parameters through which you can move transactions. We're working with Chainlink and their automated compliance engine, but you can also go to the regulators themselves where they're working sort of hand in hand with how you're building that infrastructure. And so you'll have new models of how you do cross-border transactions and the immediacy through which you can comply with different kinds of rules, whether or not it be in sort of security tokens or I'll use US language commodity tokens or anything in between. But once you start to think creatively about what that programmability looks like, and then once you get some of these actors, even on the supervisory side, kind of involved, it looks, again, very different and really very interesting.
Sara, do you want to jump in about what this compliance embedded layer can look like?
Sure.
I saw you nodding on that.
Oh, I mean,
so,
I was
yeah.
just vibing with what they were saying. I didn't have anything specific to add, but if anybody else does, I'm happy to.
I mean, just because it's kind of interesting. So, like, we have actually central banks who are literally credentialing their rules like through us right now, and we're piloting that. So now, when you think about it in a very expanded way, like, what does it mean for a regulator or a central bank or a securities regulator to be a node? They're not just sort of looking at how you sort of batch transactions. Like they can actually participate now in different kinds of ways. And again, you'll hear at least certainly more from us, but we're working in pretty much every major jurisdiction, or at least region of the world. And what you get is a bunch of lawyers and engineers trying to think to themselves, okay, compliance as we tend to think of it has been an off-chain process, right? It's like either paper or a PDF, or you're filing and sending things to Edgar that you and I have like taught in front of your classes, and then your students look at you and think, wow, that seems really old-fashioned, and you're like, it is, right? And then Excel spreadsheets, it's delightful, right? To sort of thinking about, okay, well, what happens when all that stuff is happening off of a blockchain, but the actual transaction is going on the blockchain itself, right? And so you have to figure out, like, well, what does, in our words, we've used, like, what does an operating system look like for that, right? And it's an opportunity as much as it is a challenge. And so when you're asking what it looks like, it's a layer. So it's you can think of it as a metaphor. You can think of it as an architecture. When you're sort of building the OS, or you can think of it functionally as to how do you make, at least for what we're doing, is how do you make sure what's going on off-chain is represented in a way on-chain to help not just automate the compliance, but also automate the transaction. Yeah.
Let me give an example, and I'm going to do a plug for Blueprint in a second. Plume has developed what we call the compliance layer for Ethereum. So we have the only layer 2 of Ethereum, which has embedded AML controls at the protocol level. So before a transaction is sent from our layer 2 sequencer to the Ethereum mainnet for final settlement, the wallets involved in the transaction are screened against the database provided by Elliptic of illicit wallets at a high-risk parameter, particularly for sanctioned wallet addresses. So that's one example. And actually, an interesting data point is when we first launched our blockchain back in June, we saw about a 1% failure rate. Right now, we're seeing 0.00005%, which indicates kind of the deterrent effect of having these types of controls, which I think is pretty powerful. The other instances, registered funds under the 40 Act are required to use a qualified custodian, an independent custodian, in order to avoid conflicts of interest that might come from the registered fund manager also having assets or control over assets that belong to customers ultimately. And so we're working right now to enable self-custody, in our case through a vault protocol. We're trying to address that core rationale for using a qualified custodian by using Blueprint's proof of collateral service, which provides independent third-party verification that the assets that are purported to be behind the vault are actually those assets. And so those are two examples of embedded compliance that Plume is working on.
Does anyone else have an example of embedded compliance they want to share? Okay. But if we take a big step back, though, about embedded compliance and think, do these compliance-enabled DeFi models actually solve the key barriers for adoption that we're seeing from more traditional finance and investors, or do they risk undermining what makes permissionless systems valuable? I'll put that to the group.
So one of the reasons we built embedded compliance was to encourage institutions that have to manage their compliance risks with engaging in financial activity on chain. And so it's one of the differentiators between our blockchain ecosystem and others' blockchain ecosystem, and it's been decently successful. So yeah, I think when it comes to regulated institutions, it's definitely a differentiator. But I think beyond that, over time, as liquidity, more and more assets are brought on chain by these institutions, then for those that are not subject to anti-money laundering regulation, for example, they're going to migrate to where the liquidity is. And so over time, I think you will see embedded compliance parts of the blockchain ecosystem, particularly when it comes to regulated assets, becoming the focal point for liquidity.
Maybe I can just add from the operator perspective. I think it's not what's limiting institutions. I mean, we did a tokenized equity secondary offering a couple weeks ago. And, this is just a massive, massive infrastructure built out for all of our clients. So even if we can deliver tokenized equities, all of our clients, asset managers, hedge funds, you name it, they need to have the infrastructure to be able to take delivery of the asset. But also their internal compliance departments and all of the other teams that sit in-house. It's one thing for the portfolio manager to call us and say, yes, I'm taking delivery. It's another thing for them to call their middle office and back office and get their clearance to be able to do it, because they don't actually have the process, the infrastructure, the protocol in place to do it. And that is just a massive undertaking. I think that's one of the things we're really trying to do now, is how do we help accelerate that with our clients? Because ultimately what we hear is, can you just take delivery in your PB and then convert back to traditional shares? Like, that should not be where we're going when we're tokenizing equity. We need to be able to deliver on the promise of the technology.
This is actually one of the reasons I hate the term tokenization, because tokenization is not the goal, right? It's a means to an end. You tokenize something so that it will be legible to on-chain systems. And that's what leads to the innovation. Once something is tokenized and can interact on-chain systems, that's where you get programmability and composability and all of the things that allow you to eliminate traditional intermediaries. So the point isn't tokenization. The point is the actual on-chain market structure and what tokenization enables assets to do.
And meanwhile, I think the fact that we're sort of building the road as we're driving on it is one of the pain points that comes up consistently, is that we've gotten it sort of we've been so intently focused on the tokenization sort of piece of it, and we haven't thought about the fact that sort of you can sort of fall off a cliff in terms of user experience, and I think sometimes take the wind out of our sails in terms of progress because it didn't deliver on the promise, because we weren't all the market players weren't sort of equally situated. And so the question is sort of, some of you have heard me give this metaphor before. Forgive me. It was very traumatic. In the third grade, taking you back. Not at Vanderbilt. This is not a Vanderbilt story. In the third grade, I was in the three-legged race with my very good friend Yvonne, who I'm sure was smart enough to go to Vanderbilt. So that's my tie back to Vanderbilt. And we practiced every day to get ready for field day. Okay, small town. This is a big thing. Okay. And meanwhile, despite the fact that we had practiced and practiced and practiced, once, whatever, they blew the whistle or whatever, she just ran and she dragged me with her. And so we came in second, so that's exciting. I had, burns for days. But the point is, if you're not all working together, it doesn't really deliver on the promise. And so I think that's some of the issue, is we've got some institutions that are, really bullish on this and they're ready to build and they're ready to invest. But if we don't all work together, that network effect can't really happen. And meanwhile, sort of we can say, well, see, it didn't work. And it's not that it didn't work because it couldn't work, right? It didn't work because we weren't all sort of coordinated.
I don't even know how to follow that. But so as probably the sole DeFi company here on this panel, I'd like to also share a way DeFi is evolving that is actually integrating with CeFi. So, we have this decentralized lending protocol that's governed by a DAO. But in addition, we also now have a MiCA licensed entity in Ireland, as well as a UK FCA licensed entity in London. And the idea is because we want to be able to onboard more users to access our lending protocol. And these entities are going to be doing the KYC AML. So this is probably not something you would have expected DeFi to be doing if like 2-3 years ago. If you have asked me, I'd be like, what? No way. But it is actually what's happening now. And then we're planning on also building out here in the US and getting licenses here as well. So this is really, you're going to starting to see more of an integration between DeFi and CeFi.
So we're hearing a lot of examples about integration. Is there a risk, though, that tokenization leads towards fragmented liquidity, where we're creating parallel markets for the same assets?
The answer is yes, particularly when you think about tokenizing equities. So there's a study done by sponsored by Citadel recently that looked at execution quality in tokenized equities and found actually much wider spreads, poorer executions for tokenized equities. This is a function of just how tokenized equities are currently offered. So you'll have, I don't want to name names, but you'll have one issuer that's creating an SPV that may or may not have the actual equities behind the SPV shares that are then traded on chain, but that's just that issuer. Then there's another issuer. Then there's 2 or 3 other issuers that may be offering, what may have the same underlier, but the credit risk is different. The blockchains in which it's deployed are different. So that does fragment liquidity, which is why I think it's really important for the SEC to think about how to minimize that. I think DTC's recent move to enable securities entitlements reduces that, because it reduces that reliance on that offshore SPV, and instead you have these tokenized entitlements coming out of one issuer, which is DTC, which then can be redeemed, on demand by the holder of the security for the off-chain version of the same asset, or vice versa. So I think that is an initiative that will help reduce that friction. But yeah, there is that risk, and the regulator has to be proactive in trying to reduce that fragmentation risk.
So prior to heading digital assets, I ran our emerging market investing business for over a decade, and fragmented liquidity is something we dealt with fairly often. You'd get exchanges that would woo companies. So you'd have the Nigerian company that was wooed by the London exchange to put a GDR and split liquidity. And the companies would come and say, guess what? We're so excited, we're going to have a GDR. And we would just go, no, don't do it. It's going to be terrible for institutions to try to manage that. And I think maybe 2 things on the liquidity. One, either the market solves itself, and those that are a little bit more apparent will win and be a little bit smarter about it. The other thing too is you'll have entrants that are always willing to offer you a service to help create that liquidity. So I do think there's potentially entrants that will come in and help to re-aggregate some of this liquidity. But again, maybe it goes back to the promise of the technology. I don't think our promise is to fragment liquidity here. We're supposed to be delivering on better liquidity. And I think maybe just to throw another keyword in there is I'm always worried about liquidity and then velocity. So I think I'm more concerned on what the velocity of assets potentially looks like as we continue to modernize this space and go into a 24/7 environment, and how we manage that, because that's going to be another challenge for our business.
Great. Linda, do you have thoughts on how private law can help tokenization scale?
I can certainly talk about how private laws needs to be improved to help tokenization scale. So the Aave protocol began as a simple ETH lending protocol. You put ETH up as collateral to borrow stablecoins in return, usually USDC or USDT. Now we are starting to whitelist tokenized securities like short-term treasuries. And so we really want to make sure that what we're listing is legit and bankruptcy proof. Whatever is posted to the protocol can withstand market cycles, crashes, etc. And so it brings up a lot of questions about, well, what is it that you actually own? And with V, like, I actually don't like the term tokenization. Like, what does it really mean to tokenize something? Are you really tokenizing the ownership in the security? Or are you just tokenizing the economic right to that security, and DTCC still has the ownership of that security? Like, what is it that we're really tokenizing? And then what ends up getting posted to the Aave protocol, right? And so here in the US, we have introduced UCC Article 12, which gives us the right to determine that you own your digital asset if you can show that you control it. And the reason why this happens because for centuries, we only had two types of assets. Tangible assets, like stuff you can actually touch, like that microphone or the desk or the chair. That is something you can physically possess. And then intangible assets, which are essentially like rights in action, which means you, in order to demonstrate ownership, you have to exercise a right against the other party. So usually that's like a debt instrument or security or something like that. But it could also be IP. But digital assets don't fall in either category because they're not something physical. You cannot physically possess them, but at the same time, you don't need to exercise a right against another party to prove that you own the digital asset. And so what we did here in the US was we stuck digital assets under the intangible assets category, but then at the same time carved them back out and gave them the features of negotiability. And so I'm only sharing all this because in the end though, you may be able to prove that, okay, I control that token and therefore I own it, but that doesn't mean you actually own the underlying. And that is when tokenization starts to fall apart. And so I think there's talk now about updating UCC Article 8, which is about investment securities, and that brings up questions again of transfer agents and DTCC. So yeah, that's just the US. Not even going to bring up European countries where it's even more messed up, and and in a market where we're global, this is something where we really need standardization.
We can shift gears a little bit. We have, I think, 7 minutes left, and so with that in mind, and not to open up a giant can of worms on a hot topic, but V, do you want to give us your thoughts about fairness by design and what that means in the context of MEV and thinking about that in terms of best execution briefly?
Sure, yeah. The MEV has been in the news a lot lately because, there's this whole debate going on between permissioned blockchains and permissionless blockchains, and this claim that one of the reasons institutions prefer permissioned blockchains is because they don't have to worry about things like MEV. I think that only makes sense if you assume that transaction ordering only exists in crypto, including conflicted transaction ordering and harmful transaction ordering, which just isn't true, right? TradFi just hides it better. So, through things like latency advantages and co-location, internalization, payment for order flow, right? That is transaction ordering in TradFi, right? I mean, it's not a flaw, it's not a value judgment, right? It's a market structure constraint or feature. Anytime you have a market where the demand for immediacy exceeds capacity, and that's true of both on-chain markets and traditional markets. So I think, the question isn't like, does transaction ordering exist only in crypto and not in TradFi? The question is whether in on-chain markets, you can better see it and constrain it, right? So I think it's really interesting to see how the crypto community has responded to this issue of MEV and specifically harmful forms of MEV like front running and sandwiching. So, best execution in TradFi, like we deal with it through committees and 606 reports, and, regulators try to reconstruct trades like sometimes years after the fact. Crypto took a very different approach to combating MEV, right? So on Ethereum, which has been experimenting with different design solutions for years to try to combat MEV. They've, come up with things like proposer-builder separation, where you separate transaction assembly from block proposal. And what that has led to is you can see explicitly the competition for order flow if you're an investor or potentially a regulator, right? And on Solana, which has been like tackling this problem a little bit more recently, they're experimenting with things like trusted execution environments or TEEs, in which case, in some cases, can produce actual cryptographic like attestations of how your order was handled. So this is not something that is possible in TradFi, and I think it's actually a really great example of the stuff that we were mentioning earlier, which is blockchain-based systems and decentralized software systems. They allow you to design things in a way that is verifiable, which is game-changing for both like investors who can see how their orders were handled in real time and whether their orders were handled fairly. And for regulators, right? Like I said earlier, a lot of this stuff can potentially change the nature of how regulatory oversight is conducted.
Great. If I can just make a data point I memorized for this panel. So Ethereum has made a ton of progress when it comes to combating MEV through initiatives like V mentioned, the PBS initiative, the proposer builder separation. So October 2024, out of $60 billion of transactions on the Ethereum mainnet, we had about 25 million in MEV, and now it is 10 million out of, and this is October 2025, 10 million out of 100 billion, or I'm sorry, 2.5 million out of 100 billion. So it's come down quite a bit in just the course of a year, and it's through initiatives like PBS, and then there's further initiatives happening now in terms of encrypting the blocks for validators. So it's becoming, on Ethereum at least, a relatively minor problem.
I think we'll move quickly to the lightning round, and you can kick us off with your comment on the lightning round. So
Okay,
go for it.
all right.
With
So
concluding
I just wanted to add another data point. MEVs is an issue for our users, especially in sandwich transactions, and so we worked with Chainlink to introduce what we call Oracle abstractable value, and the idea is that we actually force the block builders to hand money back to the protocol. And so we've been actually quite successful at that. Unfortunately, I forgot the figure. I had it memorized, but it was pretty significant. I almost want to say 80%. And so this is what you can do with software in a very transparent way.
Yeah, so Ethereum does this also with something called MEV share, where they actually return like order surplus to the investor or the customer, right? So it's sort of like TradFi's version of price improvement. So the point is like there's a lot of design innovation going on blockchains, where, like I was saying earlier, right? You can actually program like fairness and accountability and integrity into the system itself instead of trusting the broker-dealer to do the right thing.
Great. I think we're just out of time here, but want to have one last brief 30-second comment?
Good
Great.
horse or something like that. I mean, no, go ahead. No. I mean, I would say, looking forward to carrying on this conversation in October. I would also sort of say one of the interesting questions, even with the fairness and the fact that we have an international product, is that there are other kinds of developments that are going on in the world besides just blockchain, including AI. And when you start to pair them together, things start to become very, very interesting, even when it comes to how you mitigate or even sort of funnel different regulatory regimes, designs, and preferences. And that's also going to make the work of the regulator very different very quickly.
Thanks, everyone.
Okay.